Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, February 27th, 2026. It's 1:09 p.m. Eastern Time, and this, of course, is the last trading day of the month. You guys know where the monthly charts are. I just did a video on that. I'll probably follow up next week if there's any big changes. But again, the takeaway was I covered the major indexes, SPY and QQQ, and they're in a posture that, to me, technical analysis is all about studying past, technical similarities, patterns, conditions, and analyzing what happened next, and therefore it allows us to help with a pretty good degree of accuracy predict the future when you have comparable setups. For example, bullish and bearish chart patterns, breakouts, breaks above the 200-day moving averages, or an index or a stock losing key moving averages. What did it do in the past? So that's, again, in its purest form, really all technical analysis is. I didn't invent it, but I years ago learned to embrace it, and I will go up against anybody any day, especially in short term, days, months, weeks, compared to any other, really the other main disciplines, fundamental analysis. That's what Warren Buffett was famous for. So, as I often say, if you have a 10, 20-year time horizon like he did or did in the positions that he would take at Berkshire, then great. And if you're really good at fundamental analysis like Warren, you've got the knack, and again, you're looking out 20 years, it'll pay out. He would be, fine taking a position, watching it go underwater for years or non-performing, and finally pay off. Most of us, that's not what we're doing here. We're making money gaming the ins and outs, the zigs and zags of the markets, and individual stocks and commodities. So in this video, here's what I'm going to cover. I'm going to start out with a brief update on the equity markets. NVDA, of course, that they're out of the way now. This kind of segues into what I'm going to do. I often like to go back and just review some of the recent questions that have been put to me, or any comments that I made in the comment section under some of the posts. So I'll go back just a few days. There were a ton back here on this, under this post, 18 comments. We'll go back here. I'll give you an update there. And that's going to segue into the semiconductors, because there was a question put there. There was one on XLF, question put there. So I'm going to cover the financials, and then wheat. One that I'll hit a couple other things at the end, time permitting, Beyond Meat, Gold, GDX, quick updates there. So let's start here 3 days back, or 3 posts back. Nothing major here. Somebody asked, we're assuming we're waiting for NVIDIA earnings. That was regarding the VIX. And I said, no, I thought that day was about the only thing that I thought was an actionable trade that day, if you didn't already have a position in the VIX to take it. And I still very, very much like the VIX, as you guys know. It's completely, almost completely conditional on my outlook on the market playing out. So the VIX, again, has high double-digit, even triple-digit profit potential still from where we're at now. So I'll go over that in 1 second. So that was a VIX question. Again, you can go in here and always read up on these. And somebody asked about Netflix and any thoughts on it. Yeah, Netflix had clipped the suggested stop, which in hindsight was too tight. I should have made T4 official and then made the suggested stop calculated based on T4. I'll get to that chart in a second. But my thoughts was it still looked good. This was yesterday. Still looked good on the daily and weekly time frames with the same price targets that I gave you from the recent trade. However, it has no business taking out the recent lows at this point. So best to keep stops tight and also watch the broad market, XLK, the Mag 8s, financials for any additional sell signals. Because remember, if we get that kind of all-in moment that I think could come as early as next week, where the NASDAQ 100 QQQ takes out the bottom of the trading range, SPY takes out the midpoint of its trading range, I think it'll be a very fast and swift drop down to my next price target on QQQ. And my point is, it would take Netflix most likely down with it, because Netflix is it's not one of the top 10 components, but it's a fairly large. I think it's in the top 20 or so, maybe top 30 in the NASDAQ 100. No, it's actually a lot lower than that. It's about the top. I'll tell you right now. Click on it. It's number 13, but that includes both shares of Google, so that makes it the 12th largest holding. Let's just get to that because there was a question put. So there it is. So again, I gave you a relatively tight stop based on this target and our initial entry. Remember, this is kind of one reason that I can't publish, profitability statistics on the site. There's so many variables on these trades. Was it a profitable trade? If you took profits at the first target, we went long right off the lows. Yeah, you made some quick money on it. If you waited to buy back in, but if you just held it and you were holding out for T2, 3, or this potential 4 target, then you had the stop clipped on a daily close. I think it was 1 or 2 days below there, a couple days below there. And so again, that was a little bit wide. It should have been based on this. If that was an official target, I would have had a stop down here. Either way, like I said, you asked me my opinion, and I'll give it to you as I did. That was yesterday, and boom. So now the second target's been hit, coming up to T3. Whether it makes it to T3 and this potential T4, again, will most likely depend on the market. But what it did, it finally took out that downtrend line. Remember, we went long there. It hit a quick bounce, which was T1 was the intersecting downtrend line or price channel, and the price resistance. And then it went on to just simply extend that positive divergence that was in place when we first took it there. So that's Netflix. Go back here. Next one. That would be right here. Comments on that where was overhead resistance? This was yesterday as well. And I know that question, I know it was put to me right before, probably as I was doing or published the video. So when I make reference here, it's fine that you asked the question. I just wanted to clarify that I had just published an extensive video of XLF, again, probably about after that question was put to me. And basically, the first and most important overhead resistance levels are the 200-day moving averages, which I talked about in that video yesterday, so I don't want to spend too much time on it. I told you 5108 was, to me, a pretty important support level. It had a brief whipsaw down through below, but as I told you yesterday, I put definitely a higher weighting on the 200s. And so what we have is a loss of the 200s, a back test, followed by a pretty impulsive rejection, and another back test, followed once again by a pretty impulsive rejection. And as I believe I said yesterday, now we need to take out those recent lows. And it should be the beginning of a more powerful drop in the market. And let's get to the next update, and then I'll get to the charts of the markets. Okay, that was this one. And then yesterday, this will be the video I'm recording now will be my first post for the day. Semis are getting hard. Where would you short them? Great question. Again, while I go over these. Okay, so here's my reply. While XSD is the more diversified of the big semiconductor sector ETFs, there's 3 that I track. SOXS, which tracks the PHLX SOX Semiconductor Index. That's the first original semiconductor index, goes all the way back into the 90s. Then you have XSD, which is a more modern version. The PHLX came out way back when. It's a bit flawed, like the NASDAQ 100, because it has a very high weighting. I'll show you in a second here on the biggest semis, where XSD is closer to the how the NASDAQ 100 and the S&P 500 both have equal weighted counterpart indexes. You can trade those as well. They have ETFs for them. And that's QQQE. If you put an end at the QQQ, you get the equal weighted. So all 100 stocks have an equal weighting. And on the S&P 500, instead of trading SPY, you trade it's RSW, I believe. And now this is not an equal weighted, but it's very close. I'll show you that in a second. So my reply was, okay, so that's the more diversified of the two. And that gives you a truer picture of the overall sector. Remember, the NASDAQ 100 or on SOXX, just a few of the top components, because they're so large, can give you a false guise of the strength of the entire stock market or an index if just a few of the largest weighted stocks are doing very well or very poorly. And so that's why we look at things like market breadth, the internals. You know, a healthy market, you're going to have the majority of stocks going up in a bull trend. It's an unhealthy sign when only a handful of stocks on an index of 100 or 500 or more stocks are accounting for almost all the returns. That's what we've seen for a while now. Now it's going the other way with the NASDAQ 100. The FANGs are now sucking wind. Okay, so that one's currently much closer to triggering a sell signal, and I'll give you the charts here, which it did today, and which will trigger an objective short entry when it breaks. All right. Now, I went on to say the safest bet would be to wait for the primary uptrend lines in both XSD and SOXX to be taken out. So here's the daily charts again from yesterday. There's XSD, and it was right on the line yesterday. And then SOXX, see a little room to spare when you look at, I've zoomed in too much. I'll get to it right now. Let me get to the live charts. We'll make it easy here. Okay, XSD, again, that's the Spiders Semiconductor ETF. The other one, if I didn't mention it a second ago, there were three I follow. SMH I'll look at too, but really these are the two big ones I like to track. And that's it. So I'm going to zoom in. We were right on the line yesterday. That candle. This is today's candle. Hopefully you can see it here. There's a little red. It's flat. It's small, but that's it. So we clearly have taken out the trend line. Now you can see I have a BOD, or what I call benefit of the doubt, support level just below it at 347. Why is that level there? It was an all-time high there with the breakout. Tested it again, then started moving away, came back, back tested, bounced, came back, back tested, also back tested the trend line. And so we're on that. So yes, that is a sell signal. It's also, as you can see here, the 50-day exponential moving average. This yellow line does a good job in the shorter term of defining uptrends. You buy pullbacks to it. When it's lost, like right here, you want to be short. Then it found support at the 200. So there's the update of the semis. And as you can see here, as on January this year, so not about a month ago, a month and a half, 2 months almost now, I did an update on it. The top 10 holdings, you can see Micron was only 3.32%, PI 3.19%, ON about 3%. And so that just tells me right there, I tallied it up 9.5% for the top three. When you get down to the top 10, they made up 29% of the ETF, and there's a total of 43 holdings. So now we go to SOXX, and you can see that you have only 30 holdings, so fewer holdings, and of that you have just the top three alone make up 23%. All right, so nearly a quarter of the top three holdings, and then you go down to the top 10, and they make up over 56%. So again, now it's real money. It's a more concentrated view. So when NVIDIA breaks and these big names, AMD, NVIDIA, Micron, the ones that have been the strongest semis, you're going to get more bang for your buck shorting SOXX, most likely, because they're going to fall once the trend, the sector goes the other way. And you can see we're still comfortably above there. So when I say the safe bet, like you could certainly make a case to short XSD on that breakdown today. But you're at the benefit of the doubt support. So the way I would say it is, a partial position at most, not a full all in. All in, meaning all in, not your entire portfolio, but the amount that you want to allocate to a short on the semis would come when SOXX also gives way. And then you can see price targets, get the 200s down here. So that's that. Let's go to the next one. Most recent yesterday, I'm sorry. And no, that's it. Okay, did I cover all of them? Yeah, I did. Okay, all right, let's move on, guys. Let's talk about the markets real quick. I know some of you might be getting bored of the stock market coverage. And that's because it's a function of the fact we're going absolutely nowhere for many, many months now. This is the multi-month trading range. We're still in it. We got, as expected, told you the other day, we were bounced back to the midpoint, and we're still in the bottom half of the trading range. My midpoint line delineates the shorter term trends when you're above it, when you're below it. And so that still keeps the NASDAQ 100 at this point in time at a greater risk of breaking down below that trading range than it does breaking out above it, right? Only because of the proximity to the bottom, and then the 200s, and then there's that T2. But as I like to say, support is support until unless broken, and as exactly as I said the other day when we were here, resistance is resistance until unless taken out. So far, we got rejected off that resistance level, not by much. This is just QQQ bouncing around in a trading range. So if you're frustrated, there's plenty of individual trade ideas, individual stocks, and we've been having a field day on those in the last 6, 8, no more than that, 9 months. Here's SPY, the S&P 500, also recently made a run to bounce around the top of its, since this point here in the upper half of its trading range, there's this midpoint delineation line about 673.79 or so. And if QQQ breaks below the bottom of its range in the 200s, then again, I think SPY will come down here. Still my preferred scenario. If next week there's a little upside in the market, technically it won't change much. Might be a breakout above this trading range, but it'll simply extend the negative divergences that were in place at this most recent high. So nothing has changed in my current outlook, the technical posture, nor my expectation that we're going to go down and down quite a bit. And that leads me to the next one. Let me see here. Yeah, XLF. I already touched on that because somebody asked the question. But let's just go through the rest of the... oh, no, before I get away from the markets, I'm sorry. Let's just look at NVDA because that is very important. So as I said, nothing but a absolutely phenomenal quarter. Let me give you guys a great article to read. 1 second, let me find right here. Go to Mishtalk, Mishtlak. If you want to understand, because a lot of folks, I've been doing this a long time, and I tell you, it's almost laughable, these analysts, and you might say, Randy, I turn on CNBC, I watch Bloomberg, I watch them daily, and you're just trying to call top on NVIDIA and the semis is so futile right now. You don't understand. They say that they have more orders, and this AI thing is real, and yeah, it might be circular, but that's what it is. I would encourage you. This is a well-written article by what's his name, Mike Shell something. I don't know. He every now and then he writes some good articles. But I would encourage you to read it. And there's the headlines: largest, cleanest beat ever. He quotes all these. These are big analysts: Morgan Stanley, Raymond James, Stifel, Bank of America, Barclays. And again, you'd be very hard pressed to find a bear on this stock based on this. But again, the market is a forward-looking mechanism. And so anyways, he goes on to do a good job of explaining those circular deals and how it works, and how when that unwind does come, how powerful it can be for the sector. And so again, take a look at it, and again, if you're curious as to just how this stock, making so much flipping money, having again such a quote unquote clean, perfect quarter, with no chinks in the armor right now, how it can go down. Either way, look, I go off technicals. This is the trading range. You talk about the market being a long trading range. This is NVIDIA. We had that one failed breakout attempt, went back into the bottom of the range. And again, right before they reported, we were at the top of the range. As I like to and often say, resistance is resistance until it's taken out. And also, once you're rejected, you have the midpoint line, 179. We're on that right now. So watch that. And look at this. We're also at the 200s. So NVIDIA is in a interesting, it's still in a overall bullish technical posture because it's above the 200s. And just because it's in a trading range and hasn't gone up for months doesn't mean it can't. The nature of trading ranges is it's a period of consolidation where buyers and sellers are kind of unsure. There's equilibrium in the stock. In other words, you don't have more buyers and sellers. You have about equal amount. That's where stock won't go up. And again, back and forth. fairly large, not relatively small trading range when you zoom out and look at, the price history on NVIDIA. Again, everything I have to quote and speak relative terms. Bitcoin or silver, a 5% move is not relatively large. It's relatively normal recently. Go back 5, 10, 20 years, a 5, 10% move in silver is unusually large. So everything is relative, and it's relative to the time frame when volatility expands or contracts, right? Hopefully that makes sense. And so you also have NVIDIA currently, again, at closer to the bottom of its trading range and closer to risk of breaking down. And as I like to say, support is support unless broken. So if it breaks down, takes out the 200s, it will be the first time since back here. We lost the 200s there. We had a back test there, bounced, lost them, got rejected on the 200 exponential on several attempts. And then if you took advantage of shorting that, recognizing that it lost the 200s and shorting it, you still had another 30% downside in the stock. And again, study history. Here's where it lost the 200s here. You had a total of 58% if you took advantage of that break of the 200s. Likewise, if you're a bull, you buy the recovery back above the 200s and you buy. So that's it. That's, to me, very simple, but very worthwhile coverage in significant levels and what I call potential developments to watch for. That's, again, why I do these long-winded videos. They're potential developments. They may never happen. And look, if it goes the other way, I gave you my thoughts on it before earnings. If it goes the other way, well, you have a downtrend line here. Starts off the April lows that would be back tested on any breakout. Could get rejected there, probably would get. You also have the previous highs, and you have divergences that if we break out anytime soon will only be extended. So that's that. And there's my long-term targets that have not changed in NVIDIA, where I think when the stock finally breaks, there's that potential head and shoulders topping pattern here. You get your left shoulder head, right shoulder, neckline right here. So that would also come in with a break of the 200s in the trading range and take you. This is really now T1. Remember, it's an extension of this trade back here. We hit that T1, but this would be your T1 at this point in time. First target, really second target right here. I can move those numbers. You can just see the levels. They're marked on the chart. Okay, let's move on to the other financials. Okay, you know me and my thoughts on BDC. Oops, I went away. Business development companies, or the ETF that holds, it's the primary ETF that holds BDCs. These are private credit companies. And as I've mentioned, long before Jamie Dimon or anybody was talking about them and cockroaches in the room, I warned of a break of that level would indicate problems because the stock market was banging on all-time highs. And I picked up on this sector as something rotten in the state of Denmark, or at least in the state of private equity or credit. Boom, hit my fourth target, reversed it. We know that. We hit the first two. I canceled out T3 only because I smelled a good pullback. It was too much too fast, so we sidestepped that loss. Then when it hit the initial third target, said that would be an objective short entry. And now look where we're at. We have now taken out, we're going to go into the weekend, unless there's a stick save. That means by 4 p.m. today, we get back above there. This was a major reaction low when the markets were in meltdown mode due to Trump's initial tariffs right there and the fears and all that. And you can see right now we're at 1280. The support's around 13. So it's just, again, it's I'm watching them one by one. I've been going over these with you day by day. Now it's Hercules, HT, GC took out major support today. You can see these divergences again getting burned through. I talked on BDC yesterday, told you that, last time when we hit my fourth target and we had positive divergence, we went long, came the bounce. This time around, I wouldn't buy BDC. I wouldn't buy this sector with your money. I'd rather miss a big reversal than be caught in a potential crash. And that's what I'm going to talk about in this video. In past years, I've talked about, I use the analogy for weather forecasters, both for those of you folks that live in Tornado Alley, in the Midwest, or those of you that happen to live, where I live, Florida, or any coastal areas, Texas, Alabama. There's the National Weather Service will issue either tornado or hurricane watches and warnings. A warning is more severe, and that I forget the technical terminology. It says the likelihood is pretty high of a direct hit within a short period of time. Again, hurricanes move slower, tornadoes develop very fast, so the time frames on those two are different. But you guys know what I'm talking about. So a watch, when in Florida here, when the hurricane's out a few days away and the cone of certainty is pretty wide, they'll put you on a hurricane watch. It just says, hey, conditions are ripening, and there's a decent chance, if things continue on the way they're going, that you may have be hit by a hurricane or near hit. And then when the warning comes, it's a lot closer, right? And there's a bigger chance. So right now I'd put a crash watch on the market. I've covered that recently. I've covered my custom NASDAQ crash indicator, the Hindenburg one that I kind of modified. And again, based on the proximity to the bottom of the trading ranges. So it's only a watch at this time. A warning might come if next week we break down. Now keep in mind, I would consider it, even though I'm in Florida, and yeah, we do. Tornadoes are rare. We did have one. You could Google it. I think they call it the Iona tornado. It's the area I live in. And this was like 4 years ago. It's right before Hurricane Ian, that big one that just rocked this place. You got my wife and I were sitting in bed in the morning. It was pretty early, and I think it was a weekend. And the phones are going off with those emergency beep, beep, beep things. It says tornado, warning imminent. And everything looked outside, everything looked fine. But anyways, there was one that hit, and it did major destruction. It was an F2 or 3. Very rare. It was only the second one in I think 100 years in this area. But my point is, they happen, and they happen quick. So that's where I'm going. I'm sorry to go off on a tangent here. That in the stock market, developments can happen a lot faster. So with this continued, I'm not going to call it a meltdown, but I'm seeing one after another as I go through the these private credit companies. A lot of support. We know what happened with Blue Owl recently. That was all in the headlines. And then some of these really, I covered this one yesterday. I think it was FSK. That's part of the KKR Capital. And a lot of them just starting to break down. That leads to potential to a credit event. And then I told you yesterday, one of my favorite sectors, I still very much like the regional banks and other sectors in the financial, because problems in one area or with one single company, one single private business development company, can have ripple effects. And that's how it works. Things those loans start getting repriced, and they get repriced fast, especially when these companies are distressed, and then they're forced to sell them. And then that bullshit mark-to-market pricing that they have on them, pricing their loans at 90, 95 cents on a dollar at par when they're really worth 60 cents. Or again, if Tricolor and First Brands wasn't a wake-up call, nobody saw it coming. Again, because a lot of these loans, they're not publicly accessible. They were held, Fifth Third Bank had a stake in Tricolor or First Brands, one of them. The rest were held by private credit companies, and so those are what we call credit events, and those come out of the blue. That big company files bankrupt, but then it has a domino effect, and it came especially when it comes out of the blue. So look, all I'm saying, guys, is where there's smoke, there's fire. So yeah, it's definitely a crash alert. And again, if you're going to say, because I've looked it up, yeah, private credit is a relatively small sector of the overall debt markets and the financial markets, but the regional banks certainly are important. And then that has, again, they're all tied together. And then the larger banks, this stuff is all systemic and wrapped in together and very highly related. So, all right, I'll get off that. You guys just can, monitor the sector on your own. Monitor the individual holdings. This one's breaking down as well today, and it's still within just like BYND that I just showed you. It's not way down below support, But I mean, come on, that's just a beautiful support level, and it could stick safe or it can whipsaw. I've seen plenty of whipsaws in recent years. You almost have to count on them. A whipsaw is when you break down, shakes out the weak-handed longs, some short sellers pile in, thinking, "Oh, this one's done. It just broke major support," and then it rallies back up. So again, we'll see what happens next week, but just be careful if you're trying to catch this falling knife. I think there's more to come, more bad news in the sector. I believe with I agree with Diamond. When you see one or two cockroaches, there's usually more. So let's move on from that. There's other sectors in the private credit or in the financial markets. Private equity. Again, it's almost the opposite of private credit. Equity is ownership, credit is debt. But a lot of these companies are the same or related or both of them have their hands in the cookie jar. Here's KKR again. What is it? Kohlberg, Kravis, and Roberts, I believe. They've been around forever. One of the big private equity companies, one of the largest on Wall Street for many, many years, decades going back. It just broke support. Look at that. Now it's got a little bit of there's one reaction low right here, but this is where I have my line. Anyways, it's on a support zone, but it also took out the trend line. And so again, this is what I told you, that problems in the private credit markets will eventually spill over to private equity. They do the same kind of shenanigans. They get the liberty that private publicly traded companies don't have of marking their assets to where they think they're worth. And again, part of that is because they're not, a lot of those holdings are not publicly traded. So you almost have to rely on them to tell you what, the investments that they have in various companies are worth, because they're not trading hands publicly. So either way, just want to point that out. Some look better than others. I'm clicking through this list, and some of these aren't private credit companies. Fifth Third Bank, gave you that as a short trade. That previous one, there's another example where we hit my second target quick, reverse from there, and then I give it to you as a new trade most recently on a break of this trend line, and I give you 4 price targets, and it's en route right now. And I still very much like that. KRE, as I've told you, is the regional banking sector ETF. And again, the problems in the private credit sector, I believe, are likely and already, I believe, are starting to spill over. We have a sell signal in that bearish rising wedge I gave you. It's heading down. There's your next stop there. Minimum, I see this one coming back to here. And if the bigger sell signals on the equity markets that I'm looking at trigger, I could easily see the regional bank sector, KRE ETF, dropping down here to this $47 level. That's going to be a drop in the sector of about 37%. That's going to mean problems in the stock market if that happens, all right? What else do you have, or I have for you? KBE, this is the Spiders S&P Bank ETF. So you have other banks, JP Morgan, Bank America, the big ones in there as well. All kinds, and the regionals. So this is just a one size fits all, regionals and the big mega banks. I mean, come on, guys. That's a nice clean trend line break. I'm going to put a second trend line right now because there is one reaction that I left off. I allowed a brief violation there. This trend line that I had before was well enough defined, but now we have a confluence of support. We have a reaction there, one there. This is what I call a potential trend line. This is just me. In my book, a trend line has to have 3 distinct reactions because any 2 points can be connected at random. You have the 200s here as well and price support. So yeah, unless there's a crash, again, if there's a credit event, we can blast right down through there in the next week or 2 or months or whatever. Otherwise, probably a little downside. They're going to come in and buy the banks here. Dip buyers do what they do, like Pavlov's dogs when the bell rings. Bought it triple support, trend line, 200-day moving averages, and price support. However, whether there's a reaction there, we bounce and go up first or not, if and when that level's breaking, that triple confluence of triple, all in close proximity, including the trend line support, when that goes, very, very bad for the banking sector. And when the banking sector goes, like again, that's what I've been believing to be the last holdout, keeping the stock market afloat. It's the second largest sector in the S&P 500, the financials, that is, as a whole. BKX, this is just the KWB Bank Sector Index. I'm just clicking through my list of financial related companies. Capital markets, you guys know my thoughts on that. You got the likes of Goldman Sachs, Morgan Stanley, BlackRock, Schwab. You've got broker dealers in there, all of it. And hit the 200s, lost them, bounced. It looks just a lot like XLF, right? And so we're clearly below the 200s now. We've lost the 200s just like we did back here. And we lost the 200s, tried to regain them for a couple days, couldn't. And when it was clear to the masses that it couldn't get back and hold back above the 200s, we had one last back test, one last gift before a quick drop of about 20%. And I'll count it out for you. 1, 2, 3, 4 days, 20%. So that's what I'm trying to say. Things can move fast. And that's why I love short selling. You don't make 20% in the bank sector in 4 days. Maybe in the financial crisis after the government came in to backstop the financial system and save the banks. Other than that, you're only going to do this in bull markets on corrections. All right, a couple more for you. Capital markets, again, this is just the sector itself. I've covered this quite a bit recently. There's a beautiful, beautiful, beautiful bearish rising wedge pattern. Just like this one, you had a breakdown there. You back tested, got rejected, made a marginal and equal new high, and then a nice correction, double digit, back to the 200s, right? Breakdown, then you took out the horizontal price support. Then you had a back test of it, followed by a rejection. And at minimum, I see this one coming down here. And again, if it does, that's going to put pressure on the financial sector. It's going to bring XLF down below, which will then bring the S&P down because the financials are the second largest sector in the S&P 500. Insurance. Yeah, there's my chart kind of wobbling. It's up against resistance. There's XLF. IAK. This is an insurance ETF or insurance sector ETF. So you've got, Chubb, Progressive, Travelers, Aflac, Allstate, MetLife, AIG, Hartford, those kind of Prudential, all of them in here, in a big sloppy sideways trading range. So you want to see a breakdown below there, and that means there's big problems in the financial markets. Credit services. Includes the likes of Visa, which we're already short, MasterCard, Visa. We hit T5 the other day. I made sure I always try to share my thoughts when a target is hit, whether to sit tight or bounce. And I had a little arrow going to about right there. I'll show it to you. Okay, so that was just the other day. And there's where we shorted it way back there, right off the highs. Doesn't get much better than that. And this was the T5 hit. Expect a little bounce followed by a break and a move down to my sixth and final target. Might add additional targets, but let's just leave it for now. And remember, bulls make money, bears make money, pigs get slaughtered. If we get 21% drop in Visa, shorting it off the highs, covering it there, we'll move on and deploy that capital elsewhere. And again, if the sector implodes or goes down, Visa's going a lot lower. I can look at the weekly chart and tell you that Visa just took out, this is this purple uptrend line. This is when the stock came public in 2008. The company came public, right? There's a beautiful uptrend line, purple. This is what I call a secular primary bull market uptrend line. That thing just broke. There's a lot of meat on the bone on Visa. Well, it's going a lot lower over time. So again, if you want to shoot for the moon, and depending on where you shorted it, you can ride it down. But again, there's going to be powerful. I love trading bear market rallies. I love bear markets. I love corrections because the rallies are very powerful on the upside. The short coverings mixed in with all the hopium and dip buyers that step in. And so again, if I close the trade out at T6, which I probably will if it's hit, then I'll look for a re-entry point if there's an objective one. Otherwise, we'll just move on and fry other fish, All right. What else do I have for you? We did that. That's credit services. This is another chart of credit services. I have just different in my watch list here. Regional, another IAT, another regional bank ETF. Again, you can see this one. I'm going to move that line up there, right there. If you're trading this one instead of KRE, KRE is the one I've been highlighting for you. This is their first support. Then right here, about 51.70, and the 200's coming in there. Brokers and exchanges, and then IAI. This is the ETF for the broker dealer sector. In that, I've been very adamant that my favorite in there was Robinhood. Since back here, we had multiple sell signals down over 50% so far. Coming up, my long-term price target again was, I said this level the other day, that is support. And we've almost effectively hit it, but I have this uptrend line right here, long-term uptrend line. And if and when this breaks, this one's going a lot lower. But again, it's already been, down. It's already down 55%. And it was the king again. I'm picking on this one just based on my experience in the market, being a former stockbroker, also reading, investment advisor, financial consultant, knowing the types and reading a lot what happened after COVID when everybody got a check, got paid to sit on their ass at home, didn't have to pay their mortgage or their rent because there was rent forbearance, and you didn't have to pay your student loans, and it opened up this whole other generation of these young, not just age-wise. And again, I know a lot of you listening to me have Robinhood accounts, and I'm just generalizing here. Hopefully you're making some money on your own or off some of the trade ideas that I'm sharing here. I don't mean to, be offensive, but I am generalizing, and I understand that I can tell you that as a professional trader myself, I don't have a Robinhood account. I use Interactive Brokers. I have other brokerages as well where I have money at. Not that there's anything wrong with Robinhood. I just know from reading the type of folks that it attracted. The most of those that love playing those meme stocks, the GameStops of the world, and the AMC. And here's another one for you I missed. I'm going to show you because I hate hindsight analysis. As you guys know, I'm usually sometimes a little too far ahead of things on trade ideas. Sometimes calling tops that do come, that just take a while to come, or bottoms that take a while to come. But again, I don't like chasing things. I'm not a trend chaser. I like to identify and position for trend changes, a lot of my trades. But every now and then I miss one, and this is speaking of meme stocks, BYND. Now we've had multiple trades on this stock recently, including we bought it here last time in pre-market. It was right there, and it popped up. It hit my second target, went even higher from there. It went up total of from where we bought it at 119. The total run was about 548%. And I'm kicking myself only because the lesson here is I didn't have a price alert. You can see that I've had this line I created back. Pop-up box tells you I put that line there on January 7th, and I've been watching it. And but I forgot to set the alert. So this is every now and then I'll highlight a missed opportunity as a learning example. And you can see even more recently, I noticed this and added this downtrend line. It'll tell you that I created that on February 19th, just about a little over a week ago, waiting for a break there. And it was beautiful dual resistance. The breakout came, and it came today, and it didn't just, it was an easy breakout. It happened right here, and it was a quick 27% run up from there. So, the takeaway is don't forget to set price alerts. That's it. That would have been, I would still be sitting tight. If the market holds up, it'll probably hit these two targets. These were my two targets right here. So potentially back up here to that former T1. So maybe if it pulls back, I missed it, so I'm just going to sit aside, watch. I will consider if it pulls back. But, the thing about it, usually when these little penny stocks let loose, these meme stocks, they just keep going. If they come in and back test, it's because there weren't enough buyers on the other side of it. It was initial people that saw that support level. So I don't know. I just wanted to point that out for you because I was talking about meme stocks, and this is one that we've traded before. And we've traded this guy long and short over the years. You can go back and just pull up the, go to resources here and type in BYND, and you'll see all the posts for BYND over the years right here. going back as long as you want to go. 4 pages of trades going back on that one to, how far do we go back? In 2019. And yeah, and then covered it in a lot. Most of the trade ideas on the site I give you, the majority are in videos. I can just cover a lot more. Every now and then I'll get them out to you. What I call the official trades with the chart, with the marked up levels. Although I go over the same levels in the videos. Okay, guys, and this one I'm not going to update every day because it's broken out. This is wheat again, as far as, especially for those of you that say for kicks and giggles, let's just assume you're right, Randy, and we're going to look at a hell of a bear market, or a hell of a correction at minimum this year, or maybe that case you've laid out for a multi-year real bear market, the first real bear market since 2008. When I say real, I mean that didn't just last weeks or months, but went well over a year and dropped 50% or more. And if that comes, where to hide out? Again, this is one of my favorites. There's select commodities, not all of them, and wheat is doing. I've been on it for a while now, but we're finally moving away from that long-term trend line. Right there, this primary multi-year uptrend line comes off the 2000 lows. And here's a great example. I didn't even think about this till now. Okay, so I just said it. Where can you make money? But, let's say you don't want to short. You think it's anti-American, or for whatever reason, you don't want to short and profit on the next correction or bear market, equities that is, or anything. Well, remember, this is when the dot-com burst. It was March of 2000, right there. The NASDAQ fell over 80%. The S&P 500 was still down. I forget what it was. 50%. It was down a lot. And you can see wheat literally bottomed at the end of a bear market, and from there went up, before all is said and done, 380%. This is the measurement right here. Oh no, I'm sorry. That measurement goes off that line. I didn't even measure the whole run. I can do it for you now. You have to go to annotate, click on the measuring tool, which is, where is that one? Right here, there it is, percentage change. I put it at the bottom there. Go up to the top, 492%, right? And that started exactly when the stock market peaked. So what I'm trying to show you here, guys, it's no guarantee. Wheat doesn't trade inversely to the stock market because of any association with it, like the way the dollar and gold have an inverse correlation. It has no correlation. Therefore, I trade it on its own charts, its own technicals. And anyways, my point being that the market could go to hell in a handbasket, and it's really not going to affect wheat. People don't have to buy Bitcoin. You don't have to buy NVDA. You don't have to pay for an AI subscription. But guess what you have to do in a recession? You have to eat. All right? And these are the basics here. Wheat, corn, soybeans, beef's gone crazy high. You don't have to buy a T-bone. And you're seeing that demand destruction. In fact, we just had a sell signal hit on a target hit on LE today. But you can go down to chicken. You can go down to, maybe that's why Beyond Meat's doing well. Who knows? BYND. It's fake. Fake beef. Anywho, these are still my targets, guys. 1, 2, 3, and it's easy. Stop below if it takes out the multi-decade trend line. But it looks good. Remember, wheat, the ETN, for those of you that don't trade futures, ZW is a futures contract. This is the daily chart. I told you recently it's split. Oh, no. Yeah. I had redone the targets for you. That's right. We hit all 3. We hit T3 recently. And it's still going. And again, it is a long-term trade and a swing trade. We've had a lot of swing trades in the last couple of years. Again, they reset when it's split. I don't have all the markings here, but on right side of the chart.com, under trade ideas, you have regular trades and long-term trades. And the definition of a long-term trade, it's really closest thing I have to an investment. Long-term trades are trader investment ideas that have the potential for significant returns over a longer term period, typically several months or more. So, and again, it's not mutually exclusive. Sometimes they're usually also listed in the swing trade category, but those are the things that, I see. I feel more comfortable about if you put a gun to my head and said, here, put some money in something, you've got to throw away the key, lock it up, throw away the key for 1 or 2 years. I would pick wheat over NVIDIA 100 times over. And again, on the long-term chart, remember, it splits all my lines. That's the shortcoming of this program. When it splits, it doesn't adjust my trend lines like every other charting program does. One day I'll reach out to them and ask them to program their developers to fix that. But I'm not even, like, the targets are so, again, I'm going to go off, and I have been going off the spot wheat chart that I just showed you. So those targets are a lot higher if you're holding out long term. Again, that's like, to me, and that's where I have money in IRAs and long term accounts, and I'll still trade it in my active trading account based on the 60-minute charts. That's where you. Oh, let me I had one idea I forgot to tell you. 60-minute chart, TLT. All right, we've been just playing this one like a grand piano. This is my 60-minute chart. Shorting it for a second, third target hit, and they're going long. Or some of these were based on the daily chart as well. And then we shorted it here. T1, 2, 3, 4 hit. Then we reversed it. We went long right about here. Hit 1, 2, 3 recently. I gave you a T4, but I removed it on February 17th, right here when we hit T3. And I did that because I just had a strong feeling we'd get a pullback, which we did. So it would have probably stopped you out anyways if you're going for T4 and you raised your stop. We sidestepped that, but now look, it's coming up to that fourth target, which I removed, but I wanted to point this out as a new trade idea. We have a nice, on this 60-minute chart, one of my favorites, bearish rising wedge pattern, negative divergence. I also have it on the futures. There, right here. This is I'm using a 2-hour chart, meaning 1 20-minute candle, 6 months, just to kind of show you. Same thing on the 60-minute. There's your wedge. There's your uptrend line in which to trigger a sell signal in CW. I haven't marked targets yet on this one, but you can see the negative divergence there. Also coming up to that previous high, which is, again, correlates with that T4 I gave you on TLT. And then I haven't had any requests for updates, and that's because by intention, my posts have been light because, remember, on silver, as I highlighted and called for the night before it crashed, that once you go parabolic, you crash. There's an initial big drop, which goes about to exactly what we did. What I call about a 20-something% drop. That's what happened. But then you consolidate for a while. You bounce. You always have, and I highlighted this before and talked about it. And it's noise. So really, the my near-term confidence and degree of confidence on where we're going, I'm just kind of standing aside that messy trade for now, and there'll be most likely another leg down in silver and gold. But as I have covered in the past and recently showed you, that it takes usually it's a couple months after of consolidation after the parabolic uptrend lines break. This one was a little longer before the next leg down. So when I have a high degree of confidence, or just quick trading ops on gold, silver, I'll let you know. Gold actually broke out. Here, let me show you futures. Yeah, right now gold have this uptrend line. This is a 3-month hourly chart, GC. It's holding on this uptrend line, and I had a downtrend line here forming a symmetrical triangle, which we just broke out above. So that's bullish unless it fails. And if it fails, we go down there. I also gave you on silver and gold. Remember, I expect gold to outperform going forward. And I'm talking not in the next coming days, weeks. I'm talking over the next year or so. That's usually what happens when the gold to silver ratio troughs out, like I showed you in recent videos. But that was a balanced target range I gave you on silver right here. Remember this box? There was the crash, we hit the bottom of it there, and we're still. This is its same target range. We're still in the middle of it. I just there's some divergence, so probably get another leg down here soon. Divergent high. Let me just add a secondary trend line right here, and yeah. So silver, again, gold just broke out, so I'm not going to short silver because of that unless that breakout fails that I just showed you. Okay, that is everything. I want to, and again, GDX will follow gold and silver, so that's a given. These guys all tend to move together. Okay, it's a lot. It's everything I wanted to cover. I'm looking at my notepad. I didn't miss anything this time around. It will most likely be my only and last video for the day. So have a great weekend, everybody. This has been Randy Finney with the Right Side of the Chart.